Hello everyone, and welcome to the Beach Investment Group's annual CFAOC RFP Competition presentation. Today our presenters will be going over the following: a quick introduction to the Beach Investment Group, our portfolio performance, our economic outlook. Fourth will be our fixed income and asset allocation discussion, then our equity strategy, where we will be introducing 2 stock recommendations, and finally our portfolio construction. So let's start with Beach Investment Group's 3 pillars of philosophy. First, we have client-focused, followed by research-driven and education-oriented. Now let's meet our speakers. Today's speakers will be Anastasia, William, myself Danielle, Chase, and Jeffrey. So now I'm going to give it off to Jeffrey to talk about portfolio performance.
All right, thank you, Danielle. Now we're going to get into the portfolio performance for the year. In the blue, we have the CSULB portfolio, and in the red, we have our benchmark. Year started off pretty good, coasting through. Around February or so, we're looking at a 3.5% return on the year. Then, of course, we all know what happened in March. We had the COVID-19 pandemic and the sell-off that followed. And on March 23rd, we had reached our bottom. We were down 23%. Most of our value equities triggered their stop losses throughout March. This forced us into cash and caused us to lose a lot of money. At the time, the university had completely shut down. Nonetheless, we were meeting 3 times a week virtually to figure out the best way to overcome this challenge. We decided to continue our value strategy, but with a twist. We picked up quality equities such as Costco, Microsoft, and Berkshire Hathaway shares, which at the time were purchased below book value. We continued this strategy into April, and many of these positions are now easily up 30, 40, even 50%. Overall, the portfolio has successfully recovered year to date to currently 3.5% and is coming back very strong. The portfolio would not be where it is today if it wasn't for our reliance on fundamentals and dedication to investing. This is the kind of service you can expect the Beach Investment Group to provide.
All right. Thank you so much, Jeffrey. My name is Chase, and I'm going to be getting into our capital market outlook. As we can observe from the portfolio performance, global and domestic capital markets have seen considerable challenges throughout the course of 2020. We've also observed historical volatility throughout the past several months, shown on our proprietary turbulence index. The index gives us insights into volatility measures across 6 different markets. And although our overall outlook is positive for 2021, we still anticipate volatility to continue throughout the year as a result of several uncertainties. While most of our return to normal depends on the development and approval of a vaccine, fiscal stimulus was well targeted and consumer spending rose in the months following the shutdown. Monetary policy was also very accommodative, and record low mortgage rates also influenced a driving force of the recovery, the housing market. In addition, the U.S. has already recovered over 50% of jobs lost peak pandemic. Although more fiscal stimulus is crucial for our return to normal, these indicators reflect that the recovery process has already begun. So with that being said, let's take a look at our capital market projection and some of the contributing factors. Beach Investment Group estimates the S&P 500 to reach a target range of 3845 to 4045 in 2021. We weighted our projections against expected earnings and PE ratios from Yardeni and Bloomberg respectively to yield an average expected return of 10.18%. Factors contributing to our favorable outlook for U.S. equity markets are the current geopolitical climate, accommodative monetary policy, increased infrastructure spending, continued job growth, and consumer spending. All this considered, our projections for the 2021 domestic economic outlook are positive, with expansion continuing in all 4 quarters. I'll now pass it off to Anastasia, who will cover asset allocation and fixed income.
Thank you, Chase. My name is Anastasia Franyo, and I will be talking about asset allocation and fixed income strategy. For the asset allocation target, we decided to go with 80% and 20% equities and fixed income respectively. Continuous gradual recovery in the economy is what led us to increase our equity exposure that will allow us to tap into higher equity market returns and still diversify our portfolio with some fixed income exposure. Our fixed income portfolio is set to be focused on capital generation. While designing it, we keep in mind all of the following, but most importantly, federal funds target rate projections, as mentioned in Economic Outlook, are at their historical low, which creates a challenge for income generation, which led us to explore avenues more correlated with the equity market. Secondly, inflation, not controlled by the Federal Reserve. It can rise and potentially cause the yield curve movements. Therefore, we want to decrease our portfolio's sensitivity to that as well. While constructing weights for the fixed income instruments, we look at the benchmark, which is Barclays Aggregate Bond Index, and you can see its weights in the table on the right-hand side and its comparison to the portfolio weights. For investment grade and mortgage-backed securities, we decided to go with the market weight. Treasuries are actually said to be underweight. We expect them to depreciate since investors' confidence steepens, and we expect investors' money to flow from treasuries towards equities. TIPS exposure is said to be similar to the benchmark weight to offset inflation concerns. High-yield, preferred stock, emerging market debt are said to be overweight compared to the benchmark to gain additional yield. On the following graph, you can see that on the yield curve, interest rates for short-term bonds are near zero, and moving to the longer term, the yield curve starts steepening. Considering inflation and interest rate risk, the average duration for the portfolio is set to be lower than the duration for the benchmark. To achieve our target maturity and duration, we chose a short biased barbell strategy that allowed us to mitigate some of the interest rate risk, but still have exposure to the longer end of the yield curve that tends to have bonds with higher coupons. Shorter term end of the barbell has a larger weight than the long term to mitigate some risk associated with increasing interest rates. And now William will talk about equity strategy.
Thank you, Anastasia. My name is William Herrera, and I will be talking about our equity strategy. As a team, we researched various styles of investment such as quality, momentum, value, and low volatility. And we decided that we wanted to focus our equity investment strategy to be split 50-50 on two factors, quality and value. To understand what they are, we look at one of our current holdings, Berkshire Hathaway, which is a good example that combines both of these factors. It's a quality play in terms of strong profitability indicators such as high return on equity and return on assets. It's also a value play due to its trading low price to book. As a team, we believe that separating these factors will broaden our pool of securities to pick from and will allow us to diversify, as research shows that quality and value have a negative correlation across these two factors. We believe that with the current volatility of the market, we should invest in companies that fall under quality, as they tend to be more stable, which reduces volatility while continuing to benefit in the uptrend. We believe that quality companies with a strong balance sheet can take advantage of the current economic conditions to continue to grow in their respective businesses. We define quality as a company who have a high return on equity and a high return on assets relative to its industry that aligns with their accounting quality due to its high operating assets. We are looking to stable growth year over year and looking at what management is doing to invest in their business to continue to grow. On the other side of our equity portfolio, we'll be looking for value. The value strategy has been underperforming in the past 2 years and throughout the pandemic compared to other factors. We believe that with the vaccine news and federal support of the economy, there's a substantial upside to the value strategy, as research shows that on average it outperforms in the long term. When we look at value securities, we are looking at companies that are trading below its intrinsic value. For this, we look at two different multiples, such as price to book and price to cash flow, relative to the industry, but we're also looking for securities who are stable, which is why we look at companies with a beta on average less than 1 compared to the S&P 500. We also look for a market capitalization between 1 to 10 billion. Today, we will be giving you 2 recommendations that fall under our strategy. The first one will be Amazon as a quality play, followed by commercial metals as our value play. With a strong market share in multiple sectors and a high return on assets compared to the industry, we believe that Amazon falls under quality description. Amazon continues to be an industry leader in the e-commerce and cloud computing industry and continues to expand its operations internationally. As you see, Amazon holds a market share in the e-commerce and cloud computing of 49% and 30% respectively. As we continue to research Amazon, we stumble upon their other revenue section in their 10Ks. This section is composed of 98% concentration in their advertising business. As you see in this graph, it has a strong growth of 71% average over the past 4 years. This is due to the increasing traffic in their website and demand for e-commerce business wanting to advertise in Amazon. We also estimate that the profit margin in this business is 50%. Our discounted cash flow model projects a continuation growth of 20% year over year in Amazon's advertising business with a 50% profit margin over the next 3 years. We believe that Amazon's advertising business will be one of the drivers of free cash flow for Amazon. We estimate that the market has mispriced this growth of this business and recommend that we buy Amazon at the current price of $3,128. Our estimate target price ranges from $3,610 and $3,950. And now, Jeffrey will talk about our value recommendation.
All right, great. Thank you, William. We're now going to get into our value security recommendation, Commercial Metals Company, or CMC. Commercial Metals is an industry leader in the steel and metal manufacturing business in the United States. Here's a little info about the company and why it's undervalued. Commercial Metals is a mid-cap company. Their price to cash flow ranks in the bottom 60% of the market and is also below the industry average. Another indicator to us that Commercial Metals is undervalued is its EV to EBITDA ratio, coming in at 8.86 over the past 5 years and 5.04 this year, which is very healthy among the industry. This security is also risk averse due to its beta of 1.06, which is lower than the average. Commercial Metals also has a dividend yield of 2.31%. This is just on par with the industry. Now, all these factors combined point to Commercial Metals being undervalued by the market. Now that we have established that CMC is undervalued, we can go a little bit more in depth on their business. Commercial Metals has been a key player in many projects all across the United States. Picture it as the Academy of Sciences in San Francisco. This is the world's largest LEED certified double platinum building, which CMC contributed 400 tons of rebar to. They play a big role in sustainability company and countrywide, such as their CO2 emissions being 1/8 of the global steelmaking average. And as stated in their most recent earnings call, Commercial Metals is well positioned to handle any lingering effects of the COVID-19 pandemic. They have flexibility to fund growth, weather economic uncertainty, and pursue opportunistic mergers and acquisitions. All right, now on to the valuation. We believe Commercial Metals is strongly undervalued and recommend the immediate purchase of shares of the company. Our price target is $23 to $24 a share, and the current valuation is $20.87 a share. We achieved this valuation using both a discounted cash flow model and a dividend discount model, and we have the sensitivity analyses present in the appendix. We believe several potential value triggers lie in Commercial Metals Company, including the COVID-19 recovery and a Biden-Harris administration. We could see increased spending in infrastructure under their administration, as Chase specified earlier, as well as the possible implementation of Green New Deal policies that would radically transform the way buildings are constructed, and it would also call for the retrofitting of current standing buildings, which Commercial Metals is well positioned for. Now I'm going to pass it on to Anastasia with portfolio construction.
Thank you, Jeff. For portfolio construction, we will start with talking about fixed income. On the right-hand side, you can see ETFs that we are planning on using to construct it. Most of them are already held in the portfolio except for emerging market debt C-bond ETF. Our fixed income strategy is driven by our economic outlook and is there to complement our equity strategy. Since the equity strategy is focused on stability and our economic outlook is bullish, we decided to take on additional risk on the fixed income side and introduce new to the portfolio fixed income instruments like emerging market debt. And now William will talk about equity side of the portfolio.
Here's an idea of our potential equity portfolio. Our strategy split between quality and value are shown in blue and green shaded areas respectively. The companies that are being displayed in this chart have either already been researched and have already been recommended to our portfolio, like Visa, Microsoft, and Deckers, or are in the process of being researched and potentially being recommended. While each security is being researched, we will allocate the capital to a broad ETF that tracks the Russell 3000 to still be active in the market. Our team focuses on sustainability and risk assessment, which is why we're aiming to have a portfolio beta between 0.85 and 0.95. Based on the CAPM model, we're expecting a return of 8.8% and 9.8%, compared to our benchmark expected return of 8.4%. Given the pockets of volatility, we are hesitant about increasing our portfolio's beta and therefore are looking for other resources of outperformance, in this case with a mix of quality and value. As a team, our investment methodology focuses on doing fundamental research and finding opportunities in the market that align with our portfolio guidelines. Given our clients' needs, which are a 6% spending rate plus a 2.10% tuition inflation rate for a total required expected return of 8.10%, we are confident we can reach this goal. Over the last year, our team remained committed to uphold our portfolio goals regardless of the circumstances thrown at us.
and we plan on doing so by adhering to our 4 values. We hold 4 characteristics at our core. First is elite. We students must undergo a competitive selection process that filters for the most dedicated and hardworking undergrad and graduate students within Cal State Long Beach's College of Business. Second is experienced. Our organization boasts a 26-year tenure with our extensive alumni network who transfer accumulated knowledge over the years. Third is dedicated. We have an unrelenting work ethic and often dedicate 20+ hours a week towards our efforts. Finally, forward thinking. We center ESG for all of our investments. We want to ensure that our companies that we are looking at are aligned with our values of forward thinking. With all of this in mind, we are confident in our ability to uphold our goals for our investors. So remember to think big.